Hello, Bearable Traders. Thank you for watching this interview with one of my favorite people on Twitter, Michael Gayed. Michael, thank you so much for joining us. Michael, you are a person that I have a lot of respect because you've published papers, you've developed a trading and investing strategy, and you actually started a fund putting your own money in there. So you are the true definition of someone who put your money where your mouth is and you have a skin in the game. Not a lot of people are like that. Everybody has a lot of things to say about the market, but no one actually dares to put their money in what they believe. So thank you so much for coming. And I have one question. Today was, yesterday was NVDA's earning, and you are one of the people that are very loudly in Twitter say that NVDA is extremely overvalued and NVDA is fucked. What's your thought about NVDA earning?
Okay, so first of all, if I'm one of your favorite follows on X, you need to follow more people. 'Cause I don't think I'm all that good. I try to be comedic, obviously, and I keep saying it's a persona.
Yeah.
By the way, I am blown away how people don't seem to. Some people just don't get the humor at all.
Yeah.
They're not recognizing. It's kind of like if you don't get the joke, you are the joke, right? That kind of thing. And I appreciate you mentioning the skin in the game, because I have gone through a lot of pain in the last couple of years, right? I mean, my mutual fund, my two ETFs, Roro, Jojo, they all are using different signals, different opportunity sets, but they have the one commonality in that they rely on treasuries, right, to be the safe haven. I keep going back to people can't seemingly differentiate between me as a thought leader, analyst, persona, lead lag report, and then me of portfolio manager of these rules-based funds that would run the exact same way if I died tomorrow, right? So I can be right about something, but there's a reason why I always say path matters more than prediction, right? I can be right about a credit event, but unless my own funds happen to get it right, and then on top of that, treasuries then respond to it, I can be right, but it doesn't actually affect my own personal bottom line, right? As somebody who's the PM of these funds. Okay, now, I have been having a lot of fun with NVIDIA since March, and I've been obviously very wrong. It's not like, I started saying it before the gap up, because I saw I was getting a lot of attention, and I like being contrarian in nature. My tone is purposeful to get the reach, and obviously it's been on fire. But a lot of my criticisms around NVIDIA were more about the fact that it was running while everything else was lagging in a very big way, right? That it's more a symptom of what I consider to be a fairly sick market, So I have no dog in this fight. I have no position in NVIDIA. I don't care at all what happens, but I do care in terms of criticizing the way that people think about things and narrative following price. So the narrative I've heard for the last, 12, 18 hours is, blowout earnings, blowout revenue, or, this thing's going to keep moving and growing. And okay, that's fine. But now you're going to argue that something that's a fundamental metric tells you about a stock which is fundamentally overvalued, right? It doesn't make sense. If you're going to argue that revenue is so incredible for NVIDIA, the question is, well, how much of that is already priced in? How much of it is already overpriced in, right? So, great company. The AI mania obviously is alive and well, but I would caution people to think that a mania is justification, right, for what's happening to a stock. If NVIDIA were to get cut in half price-wise, and it kept on growing, okay. I mean, it would still be justified fundamentally to be cut in half while the company's growing, right? It's like there's a price for everything. I think that's what's missed by a lot of this. So if you can make money on it, God bless. I always go back to, you make a lot of money in manias, but can you keep it, right? Obviously, a lot of people have been right on the bull case for now, but I would just caution people to be careful, right? This... As everyone is distracted by NVIDIA, there's so many other intermarket dynamics which make me keep sounding the alarm that, I think we're on the verge of a credit event. It may have already started, and then nobody notices it until it's well underway. But, markets have a funny way of blindsiding people by making them focus on something which they shouldn't focus on, which is one single stock.
Yeah, that is correct. I think to mention that you mentioned overvalued, I think NVIDIA is trading at a forward PE of about 40, 45 now. This is very similar to what Microsoft was trading at the dot-com bubble. So around that area. So you mentioned credit event. Adi, you want to take the...
Yeah, before we go to credit event, I kind of want to talk a little bit about NVIDIA and the market dynamics. Michael, like, I find it interesting how, NVIDIA has, well, first of all, volatility matters, right? The stock was $100 7 months ago. So like nobody can stomach these type of movement. If you're an investor and you can stomach it, God bless you. But you always talk about path matters more, right? So if you can stomach the $100 to $400, good for you. I definitely can. But I find it interesting how like $1 trillion stock now is moving kind of like a penny stock, 5% intraday, 7%. Yeah, like a shit coin. And then at the same time, if this is kind of a bigger, if this is the AI revolution, shouldn't ASML, shouldn't Taiwanese semiconductor follow path? Like, why is it so, single stock? So that's kind of alarming. Are you seeing anything on the background, on the market internals that is telling you, hey, maybe something's brewing?
Yeah. Okay. Well, some people will say, well, NVIDIA is the best in class. They've got the moat. They're so far ahead. I don't. Again, I don't have a dog in this fight. I don't disagree. The narrative which is most silly to me is that AI is going to take over the world. Well, if AI is going to take over the world, I have not seen any single person say that AI is inflationary. It's the opposite.
It's deflationary.
Right? AI is disinflationary, or even maybe deflationary if it plays up. Okay, so then tell me why 30-year bond yields keep rising.
Yeah.
Right? It's not just growth, right? It's growth plus inflation, right? It's what you're getting compensated on. So here you have AI mania, and inflation expectations are rising, not for next year, but for 5, 10, 20, 30 years out. Right? So, again, maybe the bond side is wrong. Okay, it's just there's a disconnect. The other part of this, which I keep referencing, is, okay, so AI is going to take over the world. That means that these companies that can use AI end up having more efficiencies. Okay, I'm down with that. But then why is it that the vast majority of small cap stocks have gone nowhere since March? Right? Small cap stocks, small companies, which you would think would be the direct beneficiaries of the efficiency, right, that AI brings to the table. So again, maybe I'm biased because I think the whole thing is silly, just like a lot of the shitcoin crypto mania was in 2021. I see a lot of the same sentiment I saw back then, and believe me, I was loud all throughout 2021 saying, when investment becomes a religion, it's time to lose faith. I was countering all the narratives very loudly and getting all the insults back then, and I was right with hindsight. I think I'll be right about NVIDIA. I get it. It's a legit company. Obviously, it's a very big trend, but there's a price for everything, and you can't simply justify revenue as a reason for why the stock should be moving as fast as it is, when at the end of the day, there's going to be competition, and there's bigger risks from an intermarket perspective. Now, that leads to where we are here. I've kept on saying, I've been having this kind of new thing this year, right, which I'm sure you guys have noticed, where I'll mention like a month. Right?
Yeah.
So in February, I kept on saying March, right? And I'm saying that because intermarket dynamics looked like something would happen in March. Here comes the regional bank volatility surge, right? People said to me back then, this looks like your credit event, which I said in January, I suspect will happen at some point this year. And I said, no, I don't think this is the credit event. I said it's going to be volatile, but I don't think this is it. Okay, then I started saying April, and then I got more specific. I said third week, right? And my argument then was you'd probably have the start of a traditional correction, third week of April. Okay, I was right and wrong on that. Okay, conditions, I would argue, favored a correction, but AI mania took over in May, while 7 out of 10 sectors for the S&P 500 were down in May, more than 4%. So deceptive correction, I'd argue. Conditions were there. Then my own signals went to risk on, and I kept on getting more and more aggressively negative, saying this is clearly a mania. This AI mania is not going to last for that long. I do think that we're going to look back and say this was the blow off of large cap dominance. Because if this is the only reason why the NASDAQ is holding and why the S&P is holding, because of this one single narrative against everything else from an intermarket perspective, which is only worsening, then that's going to be the thing that gets taken out to the woodshed. So I've been wrong on NVIDIA. I've been wrong on AI price movement, on Magnificent 7, but every single major turn, comes from distraction around just one or two stocks, as if they are going to change the world when the world is starting to burn already.
You mentioned small caps, Michael. IWM in the last 5 years, returned only 7%, which adjusted for inflation is probably a negative return. So investing on these small caps. Michael, who is trading and investing in NVDA? You mentioned that people should stay away from these single names. There can't be retail trading NVDA like that. This has to be institutions and big money going in and out of NVDA.
Yeah, I think that's probably right. I mean, I've seen some of the data that suggests it's like institutional FOMO. But I also, I would, the thing is like price is set at the margin by the marginal buyer and the marginal seller. So if you believe that options trading and the leverage that comes from options trading, it's a tail wagging the dog, then at the margin, retail could be also pushing the price up just because of the leverage employed from the tactics they're using at the margin, right? By the way, the point about small caps is like one of the beans of my existence, just like emerging markets, right? So my mutual fund, when it's risk on, ATAX, tries to play relative strength in small caps and emerging markets. Talk about whipsaws. I mean, look what's happened. Small caps have basically gone sideways, as was alluded to a little bit earlier, but there's some big swings there.
Yeah.
Right? And it's like, so it looks like momentum's about to kick in, and then boom, it gets slammed. So it's like death by 1,000 cuts, right, with small caps. Right? And it's like, all right, you can't on the one hand say unemployment is low, the economy's firing all cylinders, the consumer is the backbone of the economy, small business is the backbone of the economy, and small cap companies suck. You can't have it both ways as far as a reason to say that the economy is strong or that everything's bullish, right? So that's why I keep going back to it's like there's so many other dynamics that are happening which are inconsistent with the narrative.
Yeah. I kind of got to follow up on this, and I love how our conversation is really flowing kind of naturally. GDP now from Atlanta Fed, they update their estimate as the new data come in. They update their estimate. Now it's estimating 5.9 for Q3, 5.9 growth in terms of GDP. And just to put it in perspective, I mean, if the stuff I learned in university is correct, we are at full employment. There is not a lot of productivity hack, so there's no labor, and rates are really high. So I'm not expecting any inflow of capital. How can a U.S. economy that sub growth, they were expecting a sub growth of 2%, now grow at 5.9? And again, similar to you, I feel like one is lying. Either the 10-year shouldn't be at 4.3, it should be a lot higher if this is a new dynamic of economy growing at 6%, because these are China numbers. Like, how do you make sense of these data?
I mean, I'd love to know what the estimates were in early 2008, right, or early 2020, right? And this is my point. It's like all these. First of all, the word estimates tells you everything you need to know, because nobody can tell what tomorrow brings. I don't care how sophisticated the models are, but everything that you hear is ultimately under AEBE, all else being equal, right? So they can forecast, but that's all else being equal. What if something between now and end of the year happens, like a credit event, right? That where spreads blow out and VIX spikes. I mean, maybe the estimates are going to be right, but they're not going to make an assumption for a credit event, right? As far as where economic growth goes. Now, this is the other thing which is also wild to me. Look at retailer stocks.
Yeah.
Not Amazon. Look at XRT, the S&P retail ETF as a proxy. Equal weight, tons of retailer stocks across all kinds of segments consumer plays. The thing looks like it's dead. I mean, I can be the most creative technician and squiggly guy in the world. And I keep going back to it's like any 5-year-old technician looking at a chart of small caps, of retailers, of emerging markets, of all this. It's like, what new bull market? What are you guys talking about? So there's just so many inconsistencies with this. And I look at the retailer side, I say to myself, okay, if the market's a discounting mechanism, yeah, maybe the higher rates are going to start to really impact things. And that's why small caps are not participating. Because at some point, these smaller companies, which are highly levered, have to deal with refinancing risk. At some point, these retailers have to deal with consumers that have $1 trillion of credit card debt. Oh, and by the way, student loan repayments starting. It's like, I'd argue that the only narrative that makes the most sense is the one that retailers are telling you, not the one that NVIDIA is telling you.
Yeah, exactly.
You mentioned, Michael, I'm a little bit less educated in finance than Ardi. You mentioned the credit event. Was Silicon Valley Bank and First Republic Bank and those collapses, was the credit event, or was it the credit event, or was it a liquidity issue? And my yeah.
No, please, sorry.
My question is that what do you mean by credit event for someone that is not educated in finance? And do you think if that credit event happens, whatever it is that you're explaining, would be small enough that the economy absorb it without breaking anything in the system? I think essentially what happened with the Silicon Valley Bank was that that crisis was small enough that got absorbed in the market by feds and everything else, and really we didn't see a systematic failure. But can you explain to me, because probably a lot of our viewers are not as educated as you and Adi in finance.
Yeah, so a credit event, another way of just saying credit event, is a sudden realization of default risk. Sudden realization of default risk, the risk that a company may not survive, right? Now, that is directly tied to the VIX spike, because when the VIX spikes, credit spreads widen 1 for 1, pretty much, right? And it goes back to volatility is another way of saying not fear, but doubt about an ongoing concern, right? In the case of the broader market, doubt about what happens to the broader economy when the VIX spikes. Okay, now a credit event is not something to be feared. It's actually something to embrace, because it means you're going to get things cheaper, because it means there's ultimately going to be an overreaction, right, on the idea that the default risk is rising, so sell everything, right? Which is where, when it comes to junk debt, it's like I put that post out. It's like I can't wait to buy the ever-living shit out of the junk debt after the credit event.
Yeah.
And I say it because my JoJo bond ETF, it's junk on, junk off, right? It's designed to play credit spreads, but like I'm being literal. It's like, there's going to be an opportunity, I think, where junk debt's going to be yielding 15, 20, 25%, even if it's momentarily, where you can really kind of load up, right, on that overreaction. But you have to wait for it to see it. So credit events typically mark the end of bear markets. The end of bear markets, right? It's the bang, right? The capitulation. And you see it in the bond market internally, not in terms of which again, why I still think we're in a bear market, right, for U.S. equities. Which again, I know it sounds crazy, but again, you look at everything else outside of the Magnificent Seven, and it's still kind of screaming, that you're still largely in a bear market. So, why do I keep saying that in the context of September relative to SVB and some of these other things? Well, part of it's also seasonality, right? September historically is the negative month on average for equities. So if it's going to hit, it should probably hit here, around this juncture. From an intermarket perspective, utilities, treasuries, they're all starting to say, get ready for a risk-off sequence, right? Treasuries, I would argue, have been volatile post-Fitch downgrade, but it looks like they're trying to get back to that flight to safety behavior, which again, I desperately need for my own funds in terms of having a chance at coming back. But you need something to flush the system from the uneducated speculators. Now, that's not me attacking retail by any means, but like there is still a lot of silliness and gambling that I see by people that are not even spending the time to learn and educate what risk management means, right? They're just still YOLOing, right? And I think, if anything, historically, bear markets tend to wipe out people like that, right? So I hate to say it in those terms in a cold way, but this is like historically true. So bottom line is, it's not something to fear. It's something that can be really actually quite good if you're going to be a longer term investor and opportunistically, tactically a trader. All I want to emphasize here is that risk is by no means dead. If anything, it's actually increased quite a bit given China, given Japan, given the Fitch downgrade, given the bank downgrades, given seasonality, given nobody's prepared and everybody's distracted by NVIDIA. And no one's prepared. I mean, there's no other way to say it.
Yeah. Michael, on the credit event, since we're talking about it, where do you think the biggest risk is? Is it in the shadow bank, in kind of the private equity side? Is it in the CREs, commercial real estate? Where do you think, if it appears, where would it most likely show itself? I know you've talked about the yen trade and the carry trade.
Yeah, I mean, so and this is why I always try to frame things in terms of conditions, right? It's like I keep using that analogy. Anything can spark the fire. It doesn't matter. It's just when the leaves are dry, the tinder is dry. It doesn't take much, right?
Yeah.
Anything can spark it. And I do think the yen carry trade is going to be probably the most likely one. whatever sparks a real credit event probably has to be something the Fed can't control. They can't try to preempt. It has to be something which is either outside of the U.S. banking system, which is why the regional bank crisis, in my mind, was never a crisis, because they could plug the whole. They have the playbook for what to do with it, right?
Yeah.
So, and they can preempt it, and that's what you saw, right? Everyone was talking about credit contracts with regional banks, that the stocks got crushed, and then 2-3 weeks later, nobody cared about it, right? So it probably has to be something that can't be easily preempted mechanically, right? So maybe it is CRE, because that's a tricky one, right? Because it's not like you have all these commercial real estate loans, maturing at the exact same time.
Yeah.
It's like a rolling dynamic, right? So it's hard to do anything about that. It also makes it, I'd argue, hard to sort of see it be a sudden event, because it's not bulleted, right, in the way that it plays out. I always go back, the simplest answer is probably the right one. Could be China, could be Japan, could be aliens, right? But it has to be something they cannot see and cannot control. That's sort of my point with it. And I could be, you said it correctly, it's like on the chance of a credit event, I could be totally wrong. You know what? Maybe September ends up being the best month for the stock market this year. It's not impossible.
Yeah, that's true.
But that's the point. Nothing's impossible. Right? It's like, if you're going to argue it's the other side, then you have to also argue that it can be, what people don't expect at all, which is, a tail event. So it's like everything else, right? You have to kind of think through scenario analysis. What are the different ways something could play out? Now, I'm very, very negative timing-wise here, and it's consistent with everything I've said all year as far as the path. Again, I have been largely right in the way that I've thought about the path. It hasn't really mattered too much for the funds, because the opportunity set has been very challenged. The worst environment in my world from a path perspective is one where it's pure risk on and pure large caps, which, by the way, is exactly what's happened this year, because it's been whipsaws outside of the Magnificent Seven. That ends up being a truism until it's not, right? So I know everyone always wants to find a reason for why, but the reality is you don't need to have a reason. You just need to know it's raining and slow down.
Yeah, exactly.
Mark,
just one thing, since we talked about KRE, which is the ETF for regional bank, by the way, is back where SVB happened. So it gave back all those gains. So if you think the market is a discounting mechanism, the market is telling you we're exactly back where the SVB happened. So either the market knows something, or I personally found that interesting. I wanted to say that the KRE ETF is exactly back right when the SVB failure
SVB
happened.
collapsed. Yeah.
Go ahead, Andrew.
So and what does that, right? And by the way, what does it mean? What's the implication of that from a credit availability perspective? There's going to be less credit.
It's tighter.
Right.
Yeah.
It's tighter.
Yeah.
Right?
Yeah.
So if it's tighter, that's how you have a credit event.
Yeah.
I mean, it's right. So it's like, I have yet to hear a counter argument that is not based on some popular narrative around why the setup is not there imminently. Right? Again, I could be wrong. Just because the setup is there, just because it's raining doesn't mean you'll crash. But it's like, to think that the all these other things don't matter because everyone just becomes. There was on CNBC, somebody even posted this saying, there was some anchor said, NVIDIA is more important than Jackson Hole. It's like,
yeah, I saw that.
Like, this is stupidity. This is how you end up having a rug pull when you have this type of mentality.
Yeah.
Jackson Hole is, I think, that when the Feds and they're meeting
it's tomorrow. Yeah.
tomorrow. So a lot of people, for the people who don't know, Michael, for the normal individual investor, people who have like hundreds of thousands, $500,000, and they want to retire in 10, 15 years, what do you recommend for them for long-term investing? I know you can't give the recommendations, but what would you hypothetically think? Yeah.
So the first thing would be sign up to your guys' channel. Okay.
Thank you so much.
Make sure that you're not a paid endorsement there. The real answer is, for most people, they should not be watching financial media and should not be on FinTwit or any social media looking at what's going on with their stocks and even logging in to see their portfolios. It's like, there's all kinds of studies that prove this. You look at 401k participants, or those people that are investing, their retirement assets. And you break them up into two different segments. Those that get monthly statements of their 401k balance portfolio, and those that get quarterly statements. This is fact, by the way. There's studies on this. Yeah. The people that perform the best longer term in their 401ks are those that get quarterly statements as opposed to monthly. And why would that be the case? Because those that are getting those statements monthly, they see volatility. They see noise. So what do? They panic. They reduce their risk exposure. Whereas if you're only seeing a data point with less frequency, right? You're less likely to panic. You're not going to see the volatility that causes the defensive positioning probably at the wrong time, which may be based on noise. So, like, the reality is, if you really want to be a true investor, this is taking outside the tactical, active trading side like you do and I do with my funds, rules-based perspective. It's like the best thing to do is just not look.
Yeah.
You're probably going to be better off. I mean, these are facts.
I'm losing my mind looking at my portfolio.
But what should they invest in there? I mean, you mentioned diversified.
Yeah.
Is S&P 500 diversified enough?
7,500. You mean in terms of what? Just equities?
For individual investors, like a SPY, just buying a SPY and just being invested in that.
I don't think. I mean, the S&P 500 is not diversified at all. Certainly not now, right? It goes back to the 7 versus the. It's like people forget that passive is a strategy, meaning it has cycles. Diversification should mean you have different things that will react off of different cycles. So that's why I always stress this point that diversification means you have to have a portion of your portfolio that you hate. You're going to hate the stuff which is not performing, which is off cycle in terms of what's happening now relative to something else that's working. But that's what non-correlation is supposed to be, right? So, no, I don't think the S&P 500 at all is diversified. Now, the thing is, let's also call a spade a spade. Diversification hasn't helped the last decade, right? Because it used to be the case, and I know this because that's how I developed the approach for my mutual fund ATAX, that there was co-movement, meaning if the S&P was running, you have a diversified allocation to international stocks, they'd co-move.
Yeah.
Right? The rising tide would lift all boats. Right? And same deal with emerging markets in particular, right? Not the case, like at all. Diversification's actually hurt, right? I mean, aside from the fact that bonds had their worst period pretty much ever last year, 60-40 stock bond diversification sucked, right? But then on top of that, you can't beat the S&P when it's the only game in town, right? Because you're diluting it from a portfolio construction perspective. So those that are viewing the S&P 500 and saying it's diversified and they're making money, God bless, they're making money. They're diversified for a very particular cycle that only favors large caps. That's not true diversification. At some point, that changes. Now, I do have this thesis that I think we're going to look back on this AI mania and NVIDIA as the symptom as the moment that the large cap dominance of the last 10 years ends. Because I still believe cycles are a thing. That large cap dominance ending would be really, really good for asset allocators, because it's very hard to beat the S&P unless you either tilt small at the right time, which is mid caps, small caps, or you tilt international. So it becomes a lot easier to comp against the S&P when other things are beating the S&P, right? So we'll see. I always try to think in terms of what's the story that's going to be written next. That with hindsight you say, well, you should have seen that coming. That's where I think this kind of AI mania, Magnificent Seven, NVIDIA, it's more symptoms of the blow off of large cap outperformance.
Yeah. I've so many follow-ups, but I don't want to get away from the U.S. economy. But since we're talking about kind of passive, and you mentioned passive is a strategy, you had a conversation with Dave Collum, and Dave had a really interesting quote that I wrote down. He said, when defined benefit plans became defined contribution plans, that's when you knew that was the end of smart money. And again, for our audience who don't know, defined benefit plan is when you're working at a place, the fund has to pay you a certain amount. Like, they have to pay you. So they need to beat the benchmark. They need to have some kind of a money. In the last 15 years, a lot of companies now do defined contribution, meaning whatever you contribute, they match it, and then the performance doesn't matter. So that has actually started this passive movement because everyone's just putting it in S&P 500. I find that quote really interesting, and since we're talking about passive, do you think there is a lack of active strategies in the market right now?
There has to be, because they've almost all gone broke, and I live in that world.
Yeah.
Right. So look, I get all this like anger and frustration and hatred by people that don't know, first of all, what it's like to be an entrepreneur in the business side of managing funds, right? Where there's all this competition, and the only way you stand out is by having the occasional shiny object moment, which people inevitably chase.
Yeah.
Because that's the only way you can compete against Vanguard, right? So like, which means you have to be ultra active, and then ultra active where you can get like something knocked it out of the park. Like my mutual fund in 2020 was up 72%. Gave it all back. Right? But it's like things like that, just from a product development standpoint, that's how you have to think in terms of a very saturated industry. Okay, so, I always go back to whether it's my funds or other active tactical strategies or hedge funds, ask yourself, what environment does a strategy not do well in? Right? What cycle does active in general not do well in? Okay, it's cycles where there's, where it's all where there's whipsaws.
Yeah.
Right? Like you guys are active traders, right? What do you hate the most? Being whipsawed to death, right? Where you get a signal that says play defense, the market says screw you, I'm gonna keep going higher. You get a signal that says I'm gonna go into small caps, screw you, small caps go no caps, keep going. Right? So it's the environments of whipsaw, which are the idiosyncratic equivalent, right, of an individual stock in active management. I'm pretty sure the last decade has been really since QE3, which happens to be around the time I launched my mutual fund, the day before QE3 started. It's been nothing but whipsaws outside of large caps. I think it's like, unless you were playing FANGs, you weren't whipsawed because you had the tailwind of the cycle, right? Favoring those large cap tech stocks. But for the reality is everybody's been whipsawed outside of that. So, going back to the question, is there a lack of active tactical? Yeah, of course, because they haven't been able to raise assets. God knows it's been hard for me, right? Yeah. With these funds, I know the research. I know cycles exist. I know that there are plenty of times you do any kind of back test going back to the 20s. Every strategy that looks great over a very long time period inevitably will have, their own respective lost decades, just like passive, right? But that's also where the opportunity conceivably is big, right? Because to the extent that you don't have active, everyone's gone towards the passive side, because if you can't beat them, join them, and the passive side is dominated by just a few select companies. Almost by definition, the anomalies which active managers would take advantage of come back, because there's fewer dollars seeking to arbitrage those anomalies out. So I'm biased in saying this, but yeah, I think we're going to be entering a golden era of active and tactical, because you had the era which was the worst for it the last decade.
Yeah.
Michael, do you believe in saying that market is efficient and market is always right?
The idea that price is truth is such nonsense to me. It's like price changes every day. So what, NVDA opened up to this morning, up 10% or whatever the number was? Now as we're chatting, it's up 3%. I thought price was truth based on fundamentals. This is like nonsense. Price is not truth. Price is a reflection of as my father used to say, price is the reflection of the sum total of all the knowledge and ignorance of market participants. Sum total of all knowledge and ignorance. Now, I do believe markets are largely efficient longer term, with the caveat that it's as efficient as it can be in the context of nobody knows what the very long term brings anyway, right? I do think though that we have probably never had a period in history where the market is also as inefficient as it is today in the short term, because of the ease with which, again, I go back to uneducated speculators can YOLO and leverage with options, with zero commission trading platforms, right? And have them think that they're geniuses, right? Because they happen to get lucky gambling with some zero DT options that causes all kinds of pricing distortions at the margin. So I'd argue that actually the market's probably far more inefficient because you have people that are in the game that are not even studying the rules of the game.
Yeah,
that's a good point. Ali, I want to ask a couple of questions about real estate. Do you have anything else before?
Yeah, I wanted to, since it's Jackson Hole's tomorrow, and we often hear. By the way, I'm really enjoying this conversation, Michael. Thanks again for joining us. We often hear Fed talking about these long and variable lags in their interest rate policy, and I was trying to find some kind of a literature that really see, okay, how long is this lag, and I couldn't find any. And my question is, we compare this hiking cycle with the 2000s, but there were interest rate swaps weren't as common in the 2000s. The derivative markets is so much more stronger. So is it possible that the economy now maybe can digest these rate hike a lot better, or is it possible maybe because of the interest rate swaps, because of the derivative market in general, maybe these long and variable lags are going to be a lot longer? Maybe the cycle, if it was 12 months, it might be 36 months now.
Okay, so I think the traditional studies argue it's 12 to 18 months.
Yeah,
right?
12 to 18.
It's kind of the rule of thumb. I think it's more 9 to 12 because of the speed with which it happened. But the idea of the economy of being able to handle, the speed, I think is questionable. One of the life hacks to losing weight, which by the way I'm starting to do this now myself, right, is chew and eat slower. Okay. Now, why is that? Because when you look at studies on when the brain recognizes it's full, there's a long and variable lag.
Yes.
Right? It's like around 10, 12 minutes, right? Where the impact of what you've eaten, right, starts to actually trigger in your brain. You're getting less hungry. So this is like the Fed basically shoved a whole bunch of food down the economy's throat, right? In the name of breaking the fastest inflation cycle with the fastest rate hike cycle in history. I'm pretty sure that the economy's brain starts to feel that with a lag. It starts to realize, wow, actually, this is I don't feel so good, right, from all these rate hikes. Now, the thing is, like, you're seeing the effect of the lags, right? Again, and probably look at the retail. I go back to what we just talked about, retailers.
Yeah,
you look at
retail.
Small guys, like all the things that are interest rate sensitive are clearly digesting, not in a good way, the rate hike cycle. But even the downgrade by Fitch, even what's going on with China and Japan, like it's all one trade, right? In terms of monetary policy in the U.S. and then pretty much everything else. So because I keep going back to, just because something hasn't happened in the past doesn't mean it can't.
Yeah.
And by the way, I'm talking from experience because there was never a time where treasuries behaved the way it did last year, even in the 70s, even in the 60s. Okay, so nobody knows what the hell the fastest rate hike cycle in history is going to do to the economy, because we have nothing to compare it against. So why is it so impossible to think that we're still in a bear market when we have no precedent for what something this aggressive does? And only now, by the way, should those impacts be felt. Again, how it plays out is everything, but I just want people to think a little bit differently. It's like these narratives are just, I think, very damaging to longer term psychology, and also just very damaging to properly thinking about what risk means.
Yeah.
Yeah, Michael, what do you think about real estate? Obviously, the mortgage rates are at the highest have been in very, very long time, 7.34%. But the real estate hasn't collapsed, and there is very little sign of prices are coming down. In Canada, it's just still on fire. And one explanation is, first of all, there's a lot of new people are coming in Canada, and also in the US. Obviously, there's shortage of supply. Yeah. Another explanation is that there's a lot of money still in there, that these 7.78% mortgage rates are irrelevant. People are buying cash or putting so much down payment that they can handle that. What's your thought on real estate?
I've been wrong on my timing on that, saying that housing was F word too, given the way lumber's behaved. Well, housing is, first of all, a very slow process, and downtrends do have counter-cyclical moments, as we know. Right? So maybe this reacceleration is just a counter trend in the context of a secular decline, because all those narratives around 7.5%, and people can handle it. Okay, they can handle it until they can't handle it. Right? I mean, I do think there's embedded in most people's psychology is the idea that they can do 7.5, 8% even mortgage rates, because they can always refinance.
Yeah, that's true.
That's a lot. Like you hear those anecdotes. I've interviewed Lance Lambert who noted that. It's like, this is one of the selling points for real estate brokers. It's like, don't worry, you can handle it now, and you can always refinance when the Fed lowers rates. Okay, well, what if the Fed doesn't lower rates?
No.
Or what if a credit event happens? Right? So it's like, which would then ultimately mean they have to lower rates, which then reliquifies. So the point is, like, you got me foaming at the mouth from this. From my point in saying this is, I think real estate is still going to be problematic. Keep in mind, right? Real estate's supposed to be an inflation hedge. The last year or so hasn't really been a great inflation hedge. Makes sense because a lot of demand pulled forward a lot of price appreciation. But if on a go-forward basis, real estate prices stay flat, but inflation is still 4 or 5%, real estate sucks then.
Yeah.
Yeah. Well, you think that they're overpriced, but it takes some time for correction.
Of course, it takes time.
Yeah.
It takes time, and I do believe in the. It was a playoff of Amy Nixon's post around Austin, Texas, homes available for sale versus Airbnbs in Austin, Texas.
Yeah, I saw that.
And so I put that line. It's like Airbnb destroyed the American dream of owning a home. I do believe that this is less of an inventory issue and more of a concentration issue. Zero interest rate policy enabled a lot of people to be landlords, to leverage up properties, buying up second, third, fourth properties, and then renting them out. Right? I mean, this is just the reality. It enabled a concentration of homes by people that normally wouldn't even consider doing it because it became so easy to do. Okay, so I think the real reality is that the inventory issue gets solved with fear. Yeah. Fear meaning what? Fear that those properties, which are, they're locked in at 3.5% mortgage rates, but suddenly they're not generating income. Suddenly those Airbnb type landlords say, you know what? People are not renting out this property. Right? I'm not getting as much income as I modeled out. I need to now sell. And because whole neighborhoods are comped based on the most recent transaction of a house that was sold, you can have all kinds of interesting knock-on effects of just Airbnb type landlords suddenly panicking out. So nothing's changed here in terms of the dynamics for the pressure on housing, and shelter is really why inflation remains sticky. So if you're going to bet on disinflation, you have to bet against housing at this point. It's just going to be a long process.
Yeah. Michael, I wanted to kind of take the conversation again about the credit spreads. And this morning, right before the interview, I saw a chart from Colin Thomas, top-down chart, and it was looking at the credit spreads difference between excluding retail. It's very tight, nothing's happening. But when you look at retail, it's actually ticking up. It is moving higher. Kind of exactly what we've been touching on. Of parts of the economy are really feeling the higher rates. In kind of your research, do you think the credit spread, is it kind of a coincide indicator? Does it have any predictive power? Like, would we know, okay, there's a market sell-off coming once the credit spread starts spiking, or no, it spikes once it's too late?
It's more the latter. It's just like the VIX. Like it's the mile marker, right? Go back to there's a credit spreads widen as the VIX spikes. If the VIX is spiking, market's already going down heavy. So there's really no time, right? It's always go back to it's about conditions. So this is actually the premise on my JoJo bond ETF, right? It's like, so utilities going back to the 1920s when they outperformed the broader stock market, like they're starting to do on a very short-term basis now. As I've noted this point that utilities against the S&P they're back to November 2021 levels, and they're kind of just meandering there, suggesting that we may be at the point where defensive capitulation finally is done, and they resume their outperformance, which would happen in advance of a risk-off high volatility juncture. So utilities tell you about volatility rising, utilities outperformance. I've showed this in the 2014 Dow Award. Volatility tends to rise on average for stocks. Higher volatility, credit spreads widen. So you can't necessarily say, well, if spreads blow out to a certain amount, I'm going to create a whole trading strategy around that, right? It's already too late at that point. You have to slow down before the accident happens. Now, having said that, just like the VIX, there is going to be, you can create strategies, it's just that signals are fairly rare. You can't create mean reverting strategies, right? So one of the papers that I put out that doesn't get as much play as the other four that won the 2020 Founders Award looks at VIX levels and then sector allocation. And the finding there was that when the VIX is above 31, 32, you want to buy the ever-living shit out of technology stocks, okay? Because typically in low-vol regimes, sectors will co-move the same way within the S&P 500. They'll kind of roughly stay in a band against each other. When you have a VIX spike, there's an overreaction relative to all other sectors in technology historically. So there's a dislocation, right, on a VIX spike. Baby out with bathwater type of argument, right? In which case, then you can really buy low and actually then play the convergence of the sector code movement of technology against every other sector. So the point is, credit spreads and VIX you can create trading strategies around the extremes. But if you're not to either, really to load up when a VIX spike above 31, 32 takes place. But beyond that, you can't really do much to prepare for knowing exactly when and reacting exactly off of when the VIX spike is just starting. Right? It's towards the end where there's maybe something you can do with it.
Very nice, Andrew.
I have no other question from Michael.
Yeah, absolutely. Then, Michael, my final question, since we are a community really focused on retail traders, and we try to do it the right way. Educate as much as possible, risk management. We try to stay away from that uneducated speculation that you always talk about. Is there something that you think retail needs to pay attention to beyond everything you talked about on Twitter, and as you said, some of it is persona and it's for the reach, but is there one thing that you think retail needs to pay attention to right now?
Books. Like, it's books. I don't know how else to say it. It's like, I spent so much of my life and career reading books, old books about markets from the 20s, 30s, 40s, new books about markets from the 90s, 2000s, right? And it's like every other endeavor. You got to study, you got to put the time and effort in. And just because what you're reading, may not always be true, doesn't mean there isn't merit to it. It's like I keep using that line. It's like I really am I fear for like the education system if this is the way people think. But I've used that line many times. I said, amateurs look to the right of the equal sign, pros look to the left.
Yeah.
Right. The right of the equal sign is, this is the profit I made. To the left of the equal sign is, well, were the variables that got me to the profit, were they valid to begin with, or was it luck or random? Right. You can't possibly know what's to the left of the equal sign unless you actually do study on things that work and don't work. Right. So it's not one and the same. The left and the right side of the equal sign are not one and the same. You don't know what's to the right of the equal sign is random otherwise unless you look to the left. So my argument would be, I think there needs to be, and I think there's a lot of retail people that do this. I mean, you guys know it yourself. There needs to be like respect for the fact that this is a very hard endeavor. And there also has to be respect for the fact that you can be the most knowledgeable person in the world, but maybe the cycle is just not in your favor. Yeah. And that's okay. It doesn't invalidate what you know just because you're not going through, some incredible performance runs. It's always about cycles, but you at least have to be self-aware of, if you're getting really good at trading, or if, to use an Nassim Taleb term, if you're just being fooled by randomness.
Yeah.
You only know that if you actually study.
Yeah. So I always see this chart of the M2, the liquidity and the market, and folks are like, what do you make of it? And I usually comment and I say, fooled by randomness. It's just if you look at the change of M2, it doesn't really impact the prices in some cases. But yeah, you're absolutely right. So you have to put the time in and just know that there is cycles in the market.
Michael, thank you so much. Did you go live on the spaces on these?
Yeah, we got 442.
Oh, perfect. Yeah, well, we just want to say hi to everyone who joined, and thank you so much for supporting that. Michael, speaking of books, why don't you write your own books? I've read your papers, amazing, by the way, but why not a book? You don't have a book, do you?
No, I republished my father's book, one of his books, which is into market analysis and investing. It has been a longer-term plan for me to update that. I mean, I just basically put it forward and republished it exactly like it was in 1990. Somebody once said to me, books are just a very expensive business card.
Yeah.
Because it takes a lot of effort, and you're going to have people still shitting on it at some point, right? And it's like, so maybe at some point. Look, I put a lot of material out. There's three things I do, right? One is the research, the persona on social media. 2 is my funds, which are separate from that. And then 3 is the work I do at the RIA I'm a part of. I barely have time for myself to begin with. It's like I'm trying to control what I can control, right? I can't control the performance of my funds. Nobody, by the way, can control the value of their portfolio. I don't give a damn what anybody says. You cannot control it. You can manage it. Doesn't mean you can control it. Yeah. There's 2 different constructs, right? So I put my time into the things which I can control, and I wait for the cycle for the things I can't, right? And while I can control writing a book, the cycle's not allowing me any time to do so right now. Maybe one day.
That's
perfect.
true. Yeah.
Well, thank you so much, Michael. I learned a lot. Always a pleasure talking to you. Always entertaining and also very educational, following your tweets. And I really appreciate your contributions to the community.
To the finance community. Yeah, absolutely. It's always a pleasure. Thanks for coming. We are planning on hopefully sometimes next year hosting another live event in Vancouver. We would love to have you. I want to kind of put you on the spot since you're also doing it on the Spaces. We would love to have you as our keynote speaker. I think our community would get a lot of value.
Yeah, it would be
out of it as well.
amazing. I don't know if you've been to Vancouver or not. In the summer, it's one of the most gorgeous
really
places.
Expensive. I know it's really expensive.
Well,
but yes, I'm happy to consider it.
Yeah, perfect. Thank
Thanks,
you so
Michael.
much. Yeah,
Appreciate
you know, you would be our guest, obviously, if you fly here to Vancouver. We appreciate that.
Thanks, Michael.
Thank you so much.
I appreciate it.
Bye.
Cheers.
All right, thank you guys.
Thank you.
Thank you.